How you can easily trade gold. On the macro chart, the higher time frame, gold has been in an uptrend since 2022. What tends to happen internally is gold tends to range. You see these ranges right here? Range and then a breakout, right? Range and then a breakout. A lot of, let's say, SMC traders, they start looking at an area of supply here and they start looking to trade that area of supply here. So what it in essence is doing here, they're building short positions out there. Retail getting more and more bearish, right? They start to enter these short positions even though we are in a macro uptrend because they believe that there is a chance that gold will pull back after that large expansion. We saw this beautiful range getting built right around there. We used the fixed range volume profile on the left side. There are three levels, very high, the very low, and the point of control. We saw that pullback into the fixed very high. We entered along, we put our stop loss below that low here, and we targeted a 2-to-1 risk to reward ratio, looking for that continuation play. Boom, taking out these shorters and resuming the uptrend right there. The amount of wins we received yesterday is absolutely unbelievable. A lot of guys were taking it exact same setup here. You know what I mean? Right in the book. And this is why you are in the Telegram group. You get a full understanding of how you can execute exactly according to the data. Right there. Boom, 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 boom. Oh my God. Really well done, guys. You guys have been killing it. Yes, sir. No clean order block. No fair value gap. Price came and tapped into the fixed value area high. Do you see that, guys? Do you see how that is turned into resistance? Do you see this range? Do you see this manipulation? Do you see this expansion? That is a buy signal on the dollar. That means a sell signal on the currencies against the dollar, okay? We see the same setup happening on the Euro USD. My goal is to show this live on stream. My goal is also just to educate you along the way and to just hopefully turn you into a more aware trader. Lucas says, why did you enter outside of New York? The confirmation was there, my friend. The confirmation was there. Yesterday, I missed out on a trade because I wanted to take it on stream. Today, I saw the same pattern playing out. I just can't ignore that. How you can use an area of consolidation, okay? First thing you do is you mark out any particular range you see in the market. You use the fixed range volume profile on the left side. Either two things are going to happen. Either price is going to pull back into that range. It will get to the fixed POC, the area where in that range the most volume was traded, and you execute once your entry model comes to fruition here, right? That is one way of utilizing a trade. And look at that beautiful expansion here. The consolidation, the expansion, the retracement, the continuation. Look at sniper entries using the hidden key levels. And I'll show you why this particular entry worked in the first place. On step 1, on the 50-minute time frame, I pull a fixed range volume profile across an area of consolidation. The red line is what we call the point of control. This is the area where in that range the most volume has been executed. Now watch what happens when price pulls back. It taps into the POC, the magic touch. That's my exact entry, extreme precision. But in step 2 comes the real edge. That lower time frame entry only works because of the bigger picture. When I zoom out to the 8, 12 hour or daily time frame, I can see the zone where institutions were already active. It's a supply zone if you're short or demand zone if you're long. That's where business was done, where the volume footprint was built. So in step 3 is where we're putting it together. So the trade looks like magic on the lower time frame, perfect precision of the POC, but the reason it worked is because the higher time frame had already been marked. Supply and demand gave me the zone and volume gave me the precise entry to avoid the false breakout so you can catch the reversal. It's a pattern that institutions use over and over again to bait the retail trader. It's called the CME and let me show you how to use it. Go to the 30-minute or 50-minute chart and mark a clean range. Just sideways price action, building pressure. This is where smart money starts accumulating. It looks boring to retail, but this is the setup. Now watch what happens next. Price suddenly spikes out of the range, usually quick and sharp. Retail traders think the breakout is real. That's the manipulation. Stops are getting triggered, breakout buyers jump in, and institutions take the other side. And after the trap is set, they reverse it. This is the expansion phase, the real and powerful move. And if you pull your fixed range volume profile across the original range, you'll see the POC sitting right at the base. That's the level where institutions build their positions. This isn't theory. It's the actual footprint of how institutions trade and bait you. How to spot where accumulation happened and the exact level where price usually comes back to. We are on the 30-minute time frame. Price is moving sideways. There's no clear trend yet, and it looks like there is nothing happening. Now I pull the fixed range volume profile across the entire range. The red line is the point of control. It's the area where within that range, the most volume was traded. The PVC often acts like a magnet, and it's one of the most important levels to pay attention to when price pulls back to it. When the overall trend is clear and price pulls back into the point of control, this is where you want to pay attention. In this example, price breaks out, and a few candles later, it comes back, touches the point of control, and launches again. That's the magic touch. No more guessing. You're not drawing on random boxes. You're watching where they load it up and where they come back to finish the job.